Good afternoon, everyone, and welcome to this next webinar. My name is Vince Olfert, for those of you that I've never met. And COVID-19 has obviously created a fair amount of uncertainty in our world, and we thought that with elections coming up and the ongoing second wave of COVID, that would be wise to provide our clients an opportunity to hear from our portfolio manager on what he and their team are doing. And so we're fortunate today to have Alec McIsaac from Antares Investment Management, and he's the head PM on the total equity and the balance mandates. Now, before I hand it over to Alec, just a couple of housekeeping items. If you have questions that you would like to ask Alec, what we'd ask you to do is use the Q&A button that's on your Zoom app. It's at the bottom on the toolbar screen. If you don't see the toolbar, just move your cursor and it should just pop up. Just send a question that you would like answered, and we will do that at the end of his talk time. We would also appreciate any feedback that you have on how we could do this better. So if you have any comments or encouragements, please feel free to reach out to your advisor. And with that, I'm passing over to Alec, and thanks, Alex, for joining us today, and we look forward to what you have to say.
Well, thank you very much, Vince, Chris, and everyone at Connect Wealth. Thank you, clients, for taking the time to listen to this today, and to those of you who listen after the fact. We last did this on April 9th, so it's effectively been 6 months since we last spoke to you. So today we're going to provide an update. An awful lot has happened in the last 6 months. Recall back then, I think we were just coming to the realization that COVID-19 was not going to be geographically limited to one part of the world. It was, in fact, a pandemic. We saw that the economy was grinding to a halt very quickly. Many of us were working from home. Kids were staying home from school. We were concerned, or many Canadians were concerned about making their mortgage payments, et cetera, because things were very uncertain. And indeed, stock markets plunged some 30% from peak to trough. So there's a high level of uncertainty back then. And here we are 6 months later, and it seems to me that uncertainty remains high, but perhaps we're learning to live with this pandemic. You know, it's not something we love having, but we're learning to live with it. And the market has certainly arguably come to grips with it. There's been a lot going on. So let's talk about some of that over the next little while. Not much has changed at Antares. You've got the same people managing your money. We got the same process. The only difference between the two portfolio managers is you can add 6 months of investment experience to both of us. And the one of us who is the descendant of Scottish immigrants has been saving a lot of money on haircuts. Okay, so we had this chart in our last presentation, and what this chart shows is 10 years of US markets well, in fact, it's the S&P 500, which is a proxy for the US market. And the argument we were making last time we spoke was that we weren't altogether surprised by the market's pullback at the time. And we were of the view that whether or not COVID had occurred, that the market was likely due for a pullback, because markets don't go up in a straight line. We had multiple years of economic expansion, of earnings growth, of dividend growth, all good things that lead to markets going up. But it seemed as though there was a fair bit of error in the market at the time. We were seeing a lot of corporations employ higher levels of debt. We saw the same thing with consumers, higher levels of debt. And these things are typically associated with a market pullback. So it happened. There's always a trigger to these pullbacks. This one just so happened to be a global pandemic, which is completely out of normal for us in terms of triggers, but there's always something. So since that time, as you see illustrated in the chart, whereas the market was just starting to recover a little bit. And, you know, frankly, at that point, we didn't know if it was a head fake or not. We thought there was a good chance that it might retest those lows. Instead, it has just marched forward in, you know, what they call a V-shaped recovery. So it's done a complete V. It has hit new highs before pulling back a little bit right now. And so the question, one of the many questions on everyone's mind is what's next? And what does this mean anyway when the market goes up this much? Okay. So having given you a little bit of context in terms of equities, I'm now going to talk about the bond market, because the bond market has a great deal of influence on equity markets for one thing. And it also matters a lot to us as individuals to the extent that we're either borrowers or savers, et cetera. So what this chart shows in a very sort of condensed form is 60 years of bond yields. And it's only one bond, and it's the US government 10-year treasury bond. So I use this bond because it's kind of a proxy for all bonds. It's kind of the one bond. If you're going to look at one bond around the world, it's the US 10-year bond. So what you see over 60 years is on the left-hand side of the chart that bond yields went up. And they peaked around 1980. I was 13 years old at the time, and I remember mom and dad's mortgage rate spiked up to like 22% or something like that. They were floating, not fixed. And further to that, I remember Canada savings bonds were yielding 19.5% one year. And I know this because my brother and I were paper boys, and he bought a couple of those bonds and made a whole lot of money. And for my part, I purchased an electric guitar and a drum kit because I thought I had a future in rock and roll, but I was quite wrong on that score. Anyway, since 1980, bond yields, as you see by the arrow, have come down fairly inexorably. In 2010, they were at 4%. And I remember thinking at the time, as I'm sure many of you did, oh, bond yields can't get lower, and relatedly, mortgage rates just can't get any lower. They're as low as they've ever been in our lifetimes. Well, they're a lot lower now, and they've become even lower because of the pandemic. Money is very cheap right now. The 10-year bond is now yielding about 0.7%. So if you're an investor in the US, park your money in the safest bond at 0.7%. Not that attractive. And so that encourages individuals and companies to borrow and put the money in other things like real estate, which of course pushes up the price of real estate assets, as you know very well, in the lower mainland of Vancouver. It's pushed up certain stocks in the market, particularly where there is growth. So money is cheap, and it's having an impact on equity markets. Before going any further, I'm going to give you a quick reminder of the process that we employ at Antares when we invest in companies, because just to remind you, we don't invest in the market. The market is 500 stocks in the US and something like 250 in Canada and thousands more in Europe and Asia. We are interested in owning individual businesses that, based on our research and our best judgment, are likely to be more valuable in the future. And we believe that, you know, the name of the game here is protecting capital and growing it. And you do that by owning individual businesses, not every single business out there. So we're very selective when we manage your portfolio. So 3 things that we look for with every company that we buy. The first thing we look for is a strong balance sheet. And put in simple terms, that just means we want companies to have modest levels of debt that can be managed easily. Particularly when times are tough, because when the economy slows down, as a business, you're making less money. It's harder to meet your interest obligations if you have too much debt. When you don't have a lot of debt, or ideally no debt and more cash on your balance sheet, you're in a very strong position to weather the storm and emerge stronger than some of your competitors who may have too much debt. So that's the first thing we look for. The second thing we look for is we want to own companies that have a track record of profits. We don't buy early stage companies that are unproven. We want to have a good idea of what a company has earned over time and is likely to earn in the future, because that is what ultimately generates value. It's a rise in those profits, which translates into higher dividends, et cetera. Those companies tend to generate or garner a higher stock price in the long run. The final piece to this is the price we pay for this, for any of these businesses, needs to be fair. In other words, it needs to be reflective of the value of the business. It's possible to buy a company that satisfies 1 and 2, and it's a great business, but if you don't pay the right price for it, it may not be a good investment. And I'm going to give you an example with one of the companies that's in the portfolio today, and that's Microsoft. So I'm going to show you two price charts of Microsoft going back in history. The first one here shows you the price of Microsoft from 1996 until 2001. And it started at sub $10 a share. And you'll recall that that was the era of the technology bubble. And Microsoft, being a technology company, was very much in vogue in the market for very good reasons, I should add. But its shares reached a peak. It happened to be, believe it or not, December 31st, 1999, just as we were turning into the new millennium, of $60 a share. So that's a 6-fold increase over 3 or 4 years then. And I can tell you, because I remember it very well, conviction among people who invested in the technology sector was very high. It was a new era. Everything was going tech. The internet was going to take over the world. There were hundreds, if not thousands, of companies that had initial public offerings on the NASDAQ stock exchange, the TSX. Many of them had no earnings at all, so they didn't meet many of the criteria that we would look for today. And I would say the vast majority of those companies have disappeared. You know, I just have to remember the Canadian market back then, and the 4 biggest companies in the market were Nortel Networks, which has disappeared, Bell Canada, which has not disappeared. And the reason Bell was so high was because it owned a ton of Nortel shares at the time. There was JDS Uniphase, which has more or less disappeared, I think. And finally, Celestica, whose stock has done absolutely nothing for 20 years. So when conviction is highest amongst the vast majority of people in the market, it's time to think carefully about whether the value it reflects the outlook. So I now move to the second chart of Microsoft, and what this chart does is it encapsulates a longer period of time. So the left-hand side of the chart shows what you just saw a moment ago, the lead up to the technology bubble, where it peaked at $60. Well, it took 16 years for the shares to reach $60 again. It didn't happen until 2016. During that period, Microsoft's sales and profits grew by a compound rate of 8 or 9%. So it was a very good company that was growing faster than the broad economy, like much faster, two or three times faster than the economy. But the shares relative to the business's value were just too high at the start of the period. It did not meet that third criteria that we have in investing. Now, incidentally, at Antares, we initially purchased the shares in 2014 in the total equity and balance strategy. So we didn't suffer for 16 years in the desert. And as you see from the chart, subsequent to that period, when the shares were actually very cheap, the shares have done very well. So let's talk about, so all that to say, we're mindful of value in this market because, as I'll allude to in a moment, within the market itself, there are companies that are getting quite expensive, and there are companies that are not so expensive. Okay, just going to grab a quick glass of water here. Now, the next 4 slides are ones that we used in our presentation 6 months ago. And I'm including them today because I wanted to give you an update of the 4 companies that we had talked about then. So one of them was Microsoft. And you know, the reasons we like Microsoft is, well, it holds a lot of cash, it's growing a lot, and its growth trajectory has had some renewal. And what I mean by that is they are benefiting as enterprises shift their data to the cloud. And that basically means, and I'm not a tech expert, but basically, whereas businesses have kept their data on site, on premise in a server stack, they're moving them off premise into the cloud, and that affords them all kinds of advantages. Well, I can tell you that this shift to the cloud is a big tailwind for a number of tech companies, Microsoft included. Microsoft is one of the 2 or 3 big players, and that has accelerated their revenue growth, which is why the market has gotten excited about the shares. But since we last spoke, when they reported their quarterly earnings, the cloud segment revenues were up 17%, and this is noteworty because we're talking about a market and an economy that are in one of the deepest recessions, perhaps since the 1930s. So the extent of the pullback in employment and the slowdown in the economy has been really severe, and yet Microsoft's cloud revenues were up 17%. That tells us that they're actually benefiting from the pandemic as businesses accelerate the shift to the cloud. And as a result, the shares themselves are up 25%. That's a big increase in a relatively short period of time. And we have, as much as we believe in the quality of the business, it's no longer as cheap as it used to be. So we have been trimming exposure in the portfolios to Microsoft, because if we don't do that, it's going to become too big within the portfolio, and we like to limit the exposure. And it's gotten expensive now, so the relative upside is not as attractive, certainly, as it was a little while ago. So in short, we still own it, but we own less of it. Next, I'm going to give you an update on Apple, another company we talked about then. And Apple, like Microsoft, has loads of cash on the balance sheet. It's growing fast, and like Microsoft, we didn't know this when we put these companies out there, but it has benefited from the pandemic because people not going into work, many have more discretionary money to spend. Many are doing exercise where they didn't before, so they're buying the watches, they're updating their subscriptions, they're spending more money on services and stuff from Apple. And earnings per share, when they reported last quarter, are up 18%. Another standout where the economy has slowed down a great deal, but the sales and profits are up significantly. And Apple started from a less expensive starting point than Microsoft did. Their shares are up 69% since we last spoke. You don't often see that type of share price movement. And again, we've been selling as it's gone up to manage the exposure within the portfolio, but we still like the outlook. I wanted to say something else and it's just slipped my mind. Perhaps it's in my notes. Just a little talking point. The day that Apple reported its quarterly earnings, which exceeded the consensus expectations, the shares jumped by 6% or something like that, in the few hours after the earnings release. That equated to a market value of US $100 billion. So, in a matter of 1 or 2 hours, the company's value increased by $100 billion. I happened to compare that to the value of Canada's most valuable bank, Royal Bank. And that same day, Royal Bank's market value in US dollars, off memory, was $97 billion. So essentially, in a couple hours of trading, Apple increased in value by the same value as Royal Bank. Wow. Okay. The third stock we talked about last year, Novo Nordisk. This is a company you probably haven't heard of because it's not one of those brand names that's out there, but they are, as indicated, they're a pharmaceutical company, and they have a dominant market share in diabetes and emerging large market share in obesity drugs. And these are illnesses that we don't take any, we don't celebrate that they exist, but because they exist, you need to treat them. And the fact is that they represent a growth industry. There are increasing numbers of human beings with diabetes and obesity who are looking for treatment. So I guess what I'm saying is there is a lot of demand for the pharmaceuticals that they make. They're a very innovative company, and so they tend to retain a high market share. So notwithstanding the fact that expenses on certain things are going down, if you have these conditions, you are going to continue to take your prescription for them. So their sales have continued to go up during the economic downturn. Their profits were up 9% since we last spoke, and the shares also have done well. They're up 14%. The final company that we highlighted last quarter is Brookfield Infrastructure. This is a limited partnership that is based out of Canada, whereas the other three, are not Canadian, but it is a global company, and they own very large, expensive, impossible to replicate assets. So they'll own things like container ports. They own private rail lines. They own cell phone towers in India. All of these assets are difficult to build. They require all kinds of permitting. And their business plan essentially is to have these assets in place. And they essentially charge a toll every time their assets get used. And the pricing contracts for these assets are indexed to inflation. So we love this business because essentially they tend to have very stable revenues with inflation protection. And that means that sales and dividends are likely to rise over time. And with that, the value of the units is likely to go up. Since we last spoke to you, its sales were up 15%. Another example of a business doing well in the slowdown. So I've highlighted 4 businesses. Coincidentally, they've all had, excuse me, it's coincidental that all 4 of the ones that we happened to highlight 6 months ago have had very good fundamental results. And, just in the spirit of being candid, no, this isn't true of every single company in the portfolio. The reason we have a portfolio is some are going to do better than others at a given point of the cycle. I can tell you, for example, a couple of holdings we have in the energy sector are down. They're not up, and the results are worse, not better, than was the case 6 months ago. And that's okay. That's why we diversify, and we don't have too much exposure in that area. But broadly speaking, the portfolio is up, and perhaps more importantly, we can't control the prices of stocks, but what we do control is the research we do, and we're very comfortable with the holdings in the portfolio. And as these 4 examples illustrate, many of them are doing reasonably well fundamentally in the downturn. So the question then is, well, if some of our tech companies are getting expensive and we're trimming them, where do we put the marginal new dollar of investments? And the answer is often in an existing portfolio holding. So, you might, for example, sell some Microsoft to buy, for example, Brookfield Infrastructure. But one of our jobs as portfolio managers is to always be looking for a new candidate for the portfolio. So we look around the world for candidates. Probably 85% of the businesses we own in the portfolio are North American, either US or Canadian, but we own some companies in Europe. We have owned a business in Japan, and we will look everywhere because at the end of the day, it's the business we want to own. We're not owning a country, we're owning a business. They tend to have global sales, and it doesn't really matter that they're located in one country or another anyway. So where are we finding interesting investment opportunities? Well, where there is growth in the market, and I've given you 2 examples with Apple and Microsoft, that is very well known. It is well known that there is growth, and that is reflected in share prices that have gone up very fast, and in some cases faster than the underlying profits. So the value of these businesses is not, it's not necessarily we're going to add the incremental dollar. Conversely, where in places in the market where there is not growth, many of these companies have a very uncertain outlook. And just to give you an example, I mean, airlines, for example, or casinos, or anything where people gather, where they congregate, the outlook is very uncertain for them. And, there's a question about whether, for example, movie theaters are going to survive, because some of them have taken on a lot of debt and people aren't going to the movies right now. So, it's very difficult for us to allocate our investors' hard-earned money in some of these businesses when the outlook is so uncertain. So where we are looking is companies where the share price might reflect a downturn in the fundamental fortunes, but that downturn, in our judgment, is likely to be temporary. So I'm going to give you one example of a name that we added to your portfolio in the last quarter, and that's Wells Fargo. It's a US-based bank. Some of you may have seen in the news, or I think there was even a movie, a documentary on Netflix, which I've been meaning to watch, but I haven't. But Wells Fargo has been in the news, and it's a bit of an ugly duckling in the sense that the shares have come down a lot. And this is, by the way, is before we bought them. We bought them after they fell. But it's been a bit of an ugly duckling because, in short, they broke the rules. So in 2016 or thereabouts, some of their staff were basically pressured to open up client accounts. That's how they made more money. So they opened up client accounts, customer accounts, but they didn't actually ask the customers if they wanted those accounts. So they were kind of juicing their profits for a short period of time. But as with anyone who breaks the rules, this got discovered. And the company has been in the penalty box for a few years. So in those few years, they have had a change of chief executive officer, CEO, who has replaced a lot of senior management. They have paid significant fines and significant legal costs, and all of this depresses profit. That is, on the face of it, not good, but in our judgment, this is temporary. It's fixable and it's temporary. And so given that they've got new people in there, they're dealing with their legal issues, we look at the fundamental results, and the fundamentals tell us that despite the bad news in the media, this is a company that has very high net interest margins, which is where banks make money traditionally. And we give you the example here, their net interest margin is 2.53%, much higher than that of Bank of America, which is at 2.09%. They're consistently high. And what that means is when these expenses related to legal costs start to go away and we see the end, the profits of the bank are likely to increase. And in the meantime, the shares now trade at 0.6 times book value, below book value. The 10-year average book value multiple that they trade at as 1.4 times. So they're essentially, in our opinion, more than 50% on sale with a problem that is fixable. It seems likely to us that it's going to take a bit of patience, but it seems likely to us that they fix these problems and all of the naysayers come on board. And our hope is that the market is willing to pay a higher multiple of book, meaning the shares should do well. So a little patience is required, but that is an example of where we are finding an opportunity in the market, and we will continue to look for this type of thing. Okay, so in closing, the notion that quality matters, in other words, the balance sheet and the quality of the earnings, this always matters with every business we're looking at, and that will always be the case. But what I also want to say is the market dynamic has evolved. It's changing. Markets, first of all, the fundamentals of large areas of the economy are a lot more uncertain than they used to be. So it's very important to be selective. And as I tried to illustrate with the example of Wells Fargo, there may be pockets within the market where there is significant unrealized value where the story, we hope anyway, is going to change for the better. So that is where we're looking at the margin, because where there is growth is very scarce and it pushes up the prices. It's the case with some tech companies. It's the case with real estate in the Lower Mainland. Where is the value? Well, the value might be in, I don't know, Prince George in BC, just as the value is in select areas of the market. And the last thing I want to remind everyone of is that the commitment to the process is vital. And the process is us following our investment process, which I outlined earlier, but it's also on you to follow the process that you have with your financial planners at Connect Wealth. The financial planning process is key to your success, broadly speaking, financially, and more specifically in the investment area that we oversee at Antares. So having said all that, it's about a half hour. I'm going to grab a breath of air here and open it up.
Excellent. Well, thanks, Alec, for your comments and feedback. Certainly appreciate that. There's just a few questions that have come through while you've been chatting. One of the questions or comments was the S&P 500 appears to be, moving towards a pullback. Would you agree with that? Are you seeing concerns around that, or what are you seeing on that side?
Well, it's a good question, and it's a question that that involves predicting the future, and it sounds a little bit like a technical question. Stocks move up, they follow patterns, and they move down, and that sort of thing. And we don't do that type of thing from a technical perspective. What I'll say is this: what we see in the market is we see certain areas that are very expensive, and let's be clear, the S&P 500 is up year to date, but it's really up essentially because of 5 stocks, right? These mega cap sort of internet type stocks. There's Amazon, there's Facebook, there's Google. We don't own those 3. Wish we did, but we don't. There's Microsoft, and there's Apple. We own those ones. Wish we own more, but anyway, it doesn't really matter. Outside of that, there are massive chunks of the market that are down. I'm not sure if I mentioned it earlier, but a full 56% of S&P 500 stocks are down year to date. The majority of stocks are down. So to say the market is due for a correction is probably really to say that that particular area is due for a correction. And, it may be due for a correction, but if that is the only area with earnings growth, it's hard to say. If bond yields stay very low, like I look at Microsoft with a 3% free cash flow yield. 3% is not that great. But then I compare it to that 10-year bond at 0.7%. Well, if you're picking between these two artificial choices, which do you take? 0.7% or 3%? I might take the 3, particularly since the 0.7% is a locked-in payment for 10 years, not inflation protected, whereas Microsoft's free cash flow is likely to go up during the next 10 years. So it's not cheap, but it's not necessarily expensive either. So is the market due for a pullback? Maybe. It's hard to say. There's a lot of dynamic there. There's the health pandemic, there's corporate earnings, there's the US presidential election. I mean, you may have a question on the presidential election, but if you don't, I mean, markets don't like uncertainty, they like certainty. So if there is an uncertain outcome after the vote, that may not be good for markets. If there is a clear winner, be it Biden or Trump, you don't have to like one more than the other as a market observer. If there's a clear outcome one way or the other, that could be good for markets. So it's really hard to say. But what I can say with a certain amount of comfort is that some areas of the market are very expensive. So the market could indeed pull back, but that doesn't mean all investments will pull back, because whole areas have lagged. They could actually just replace. Leadership could change within the market. Mm-hmm. Long answer.
No, it's a great answer. It's a great answer. And we happen to be using a program called Zoom for this webinar, and someone was asking, is Zoom being assessed as a buy? Is that something that Antares would consider? Or is that something that may have peaked or whatever based on where the world is at?
Well, that's one of, the thing about investing is you're always humbled by both decisions and mistakes you make, and also the things that you don't buy, right? So, if I had my time back, I would have bought a whole lot of Zoom and Facebook and a bunch of other companies at the start of the year, but we're very selective in the number of businesses we own. We typically want companies that pay a dividend as well. Our clients, our retired clients want the dividend for income, and our clients who aren't retired yet are happy to get dividends because we take those dividends and reinvest them in more shares, so they benefit from the compounding of that. So some of these companies are growing fast and aren't paying a dividend. Zoom is one such company. I don't watch it closely. It's trading at a very high multiple of sales. That, I've been doing this long enough to know that I'm not going to say it's overvalued, but it's certainly not at all remotely cheap. And its price assumes a great deal of future growth. I hope they get it. They may or they may not. I also hope that Microsoft gets it from Teams, right? So we own exposure to that type of technology through Microsoft. And we also have some sort of indirect exposure to it through Cisco, which is actually a cheap tech stock that has, what is it? I think they own the WebEx platform as well as others. So Zoom in particular, I don't follow that closely, but it is very expensive. No comment on the share price.
Excellent. Love it. Hey, you made a comment earlier that earnings growth was 18% on Apple compared to 69% share price growth. Does that kind of reflect that it's too expensive now? Is that something that Antares is looking at, or do you still think that there's good value there for what shareholders own?
So when we purchased it, maybe two and a half years ago. I don't remember exactly. The free cash flow as a percent of the price was around 6%, if I remember correctly. So the higher the free cash flow as a percent of the price, the better value it is, right? When we bought Microsoft back in 2014, the free cash flow as a percent of the price was close to 10%, which was very attractive value. 6% was attractive value at the time. It's now at 3%. So it's the same. That's the same value as Microsoft. It's 3% of that, or something that isn't growing, or a bond at 0.7%, or a little bit higher. It's not cheap enough to buy to a full 5% weight of the portfolio, but it isn't so expensive, and it has enough growth that we still want to own it at about half that weight in the portfolio. So it's a bit of a, managing a portfolio involves making decisions not just of what you own, but of how much of each position you own within the portfolio. So we didn't let it go to 5%. We've been paring it down to about 2.5%. So that's the compromise. And frankly, it's a bit of a balancing act. If we were to find something that had the same fundamental sales and profit growth, but was a lot cheaper, we might choose to replace Apple with it. But until we actually find that company, I would rather own Apple than not.
Right. Great. With all the uncertainty that we're seeing right now with regards to COVID, the elections, we've had some clients asking about gold and silver. Should they be buying it or not? Even some people saying, should I just go all to cash? What are your thoughts around those concerns or those thoughts?
Well, I think I'll say first of all that I think there are real reasons for concerns. Like, I'm not going to just say you shouldn't be concerned. Like the uncertainty is elevated. The pandemic creates a dynamic in the economy, in politics, in the market that frankly, we don't know what it all means yet. So there are elevated levels of uncertainty in the political situation south of the border, and frankly in other European countries, is also creates more uncertainty than I would say was the case 3 years ago, let alone 5, 10, 20 years ago. So uncertainty is elevated. But Vince, you and I have been in the business for a long time, and I mean, how many times have we had the conversation about, in these uncertain times, the world is always uncertain. The future is always unpredictable. We can't change that. And yet, the share price of good quality businesses that are priced at a reasonable level go up over long periods of time. They go up a lot. They go up a lot more than other asset classes. It makes sense to own them. So rather than get hung up on Should I be out of equities and in cash or in gold? And I'll address gold separately in a moment. The fundamental question for me is, what can I own that is likely to increase in value within my time horizon? And the answer to that is the shares of quality businesses that are fairly priced. It always is that. So when it comes to gold, the argument for gold is essentially that it's a store of value in highly uncertain times. And there is an argument that the value of currency is going to depreciate with governments borrowing scads of money and with central banks printing money. I hear you. There's some concerns there. I don't know how it all plays out. But again, if we have an inflationary environment, companies with competitive advantages, and I would put some of the ones I've mentioned before, their products are likely to remain in demand. And if they're in demand and unique, they can raise the prices. So as long as they have pricing power, in some ways inflation is good for them because they can actually grow their earnings at a high clip. So do I want to own gold? Well, gold itself is an asset that has no industrial value. It has a value kind of like currency because we agree it's worth something, but that value fluctuates a great deal. It's highly volatile. It's highly unpredictable. The value can be destroyed if you find a big kahuna mine somewhere and just start. It's like printing money. You can produce a lot more gold. It's hard to say what it's worth. It doesn't pay a dividend. It'll never pay a dividend. It's just gold. So you could buy gold shares. Problem is the shares of gold companies are notoriously A, volatile, and B, gold companies have not earned their cost of capital over long periods of time ever in my investment career. They are right now, but the pattern is they stop earning their cost of capital. So they've not been a very good investment for investors. So all that to say, enter these things at your own risk. Be very wary. Make sure you understand the risks. And by the way, just because you're worried about bad things happening doesn't mean you're right. We're always wrong on these things. Trump won the election 4 years ago and the market went down like this and everyone said, oh my gosh, Trump's the president, it's going to be the worst thing ever. And then before the day was over, it was up in price and the market went up in a straight line to 2019. So, having these opinions doesn't translate into good investment decisions. Buy great companies. That's what I say.
Great. And on that last question I'm going to ask before we run out of time, what's your view of energy, speaking of price takers, and more specifically oil and gas stocks, for example, TC Energy Corporation?
Excellent question. So energy, like gold, the sector in general has not been very good to investors. It's been very good to Bay Street. It's been very good to Wall Street and the London Stock Exchange because they keep on going to the market to raise more debt and to raise more equity because they haven't earned the cost of capital. That said, what we have right now is we're 4 or 5 years into a major downturn in the price of the commodities. Energy producers have been going out of business. That has continued in a $40 oil environment. So my view is, while I probably don't want to own many of these companies for very long periods of time, I think there's an interesting investment opportunity right now. And by right now, I mean between now and the next few years, because I'm going to get the timing wrong, but there are a small number of these companies that have strong balance sheets, which tells me they are likely to survive the downturn while their competitors are going out of business. They have low cost of production. Again, they're likely to survive the downturn. At some point, presumably, the world economy is going to improve. Now, is that 6 months from now? Is it 3 years from now? I don't know. But when the market gets a whiff of it improving, the price of the commodities is likely to go up. And when you have fewer companies producing it, less supply, more demand, guess what happens? The price of the commodities goes up and the market sniffs that out and it pushes the prices of the stocks up. So we have been gingerly purchasing shares of some of these companies and they've gone down, not up. It's impossible to get the bottom, but I say that one of our jobs, one of the reasons that we get paid is to make difficult decisions and to have the courage to make difficult decisions, looking out a few years. You know, when the turnaround comes, it could happen very quickly. And if you're not there ahead of time, you'll miss it. So we're being very careful. We're being very selective. I think there's money to be made, but it will be volatile. Not much exposure in the portfolio, but if that works well, and I think there's a good chance it will contribute to returns sometime within the next few years. Excellent. Hopefully soon.
Hopefully soon. Yeah, exactly. Hey, Alec, thank you so much for making time for our clients today. A lot of information there, and hopefully that was valuable for everyone who was able to tune in or those that are watching the recording later. For those of you that are listening live or are listening to the recording afterwards, if you have further questions, feel free to reach out to your advisor at Connect Wealth, and we can get the answers for you from Alec and his team, or you can reach out to Alec directly if you'd like. So on behalf of all of us at Connect Wealth, thank you so much for making time today, and we wish you a good day.
Thanks, everybody.